This podcast is intended for educational purposes only. It is not to be construed as an offer, solicitation, recommendation, or endorsement of any particular security, product, or service. For more information, visit assetbuilder.com. From the Asset Builder headquarters in Dallas, Texas, welcome to the Keep It Simple podcast, a show that discusses simple techniques and philosophies to help de-stressify investors around the world. I'm your host, Joey Badinger, and welcome to the Keep It Simple podcast. Welcome back, everyone, to the Keep It Simple podcast. I'm your host, Joey Badinger, and we're coming to you from the Asset Builder headquarters here in Plano, Texas. Hope everyone's doing all right. Today, we're going to be doing a short form podcast, so just really a 10-minute or so podcast to hopefully just review this one big, beautiful bill that passed recently. We're not really going to dive too deep into it. I mean, each of these topics you could probably spend a little bit more time on. But we just want to make sure everyone's up to date as far as the implications of this bill for individuals. We're not here to really comment on whether we think the bill is a good bill, if it was wise, if it was bad, either case, right? We're just more looking at what does it mean for individuals? And there might be more out there than this, but we really just want to try to deliver it in a bite-sized form. So let's get into it, right? The One Big Beautiful Bill Act was signed on July 4th of this year, and it does have some implications for everyone, and then there's some specific implications for individuals, for specific areas in individuals' lives. So what are some provisions for everyone, right? So they permanently extended the Tax Cuts and Jobs Act tax rates, right? So basically what's been going on, the tax rates that have been in place since, I think, 2017 are permanently extended, as well as the standard deduction. So, and this will be tied to inflation, so it'll rise over time. Caps for itemized deductions at 35% for high earners. In most cases, individual payers will get the full value of their itemized deductions, except for those in the highest individual income tax bracket, which is the 37% tax bracket. The SALT deduction cap, or the state and local taxes deduction cap, was raised from $10,000 to $40,000, increasing annually and phasing out at about $500,000 in modified adjusted gross income. So if you're a really high income earner, it does phase out, right? You don't get the full benefit there, but it did go from $10,000 to $40,000 as far as deduction. So that's a big deduction potentially for individuals. The AMT exemption, or the alternative minimum tax exemption, was permanently extended and is going to be inflation adjusted. It also reverts the exemption phase-out threshold to 2018 levels. So for those who make $500,000 or more as a single filer, or $1 million as joint filers, this was indexed to inflation as well. So that'll go up over time. Child tax credit was raised to $2,200 per child. That's not a deduction. That's a tax credit, right? So even bigger deal. But it was raised to $2,200 per child beginning in tax year 2025, so this year. And that'll also be indexed to inflation. So again, going up over time. And then the permanent charitable deduction for non-itemizers was $1,000 for single filers and $2,000 for joint filers. That's really, I think, the big thing. The biggest of those things, in my opinion, would be the permanent extension of the basically current tax brackets we have. That's not going to revert. Those were set to sunset in, I believe, 2026, and now they're not. They're going to keep on going. So now let's get into a little bit more specific areas, right? This for specific demographics in our country. For seniors, there is an enhanced standard deduction for seniors, right? It temporarily adds, and again, temporarily is a key word there, but it temporarily adds a $6,000 deduction for each qualified individual senior through 2028. So only 3 more years, really. The senior deduction begins to phase out when the taxpayer's modified adjusted gross income, or MAGI, exceeds $75,000 for a single filer and $150,000 for joint filers. A qualified individual, again, just make sure that we're all on the same page, a qualified individual is a taxpayer who is 65 or older. I think they were originally trying to get it so that Social Security wasn't taxed at all. They couldn't get that passed, and this was kind of the compromise they came to. So you may or may not, depending on your modified adjusted gross income, or MAGI again, you may or may not get the $6,000 deduction. But definitely something to talk to a CPA about and ask questions about. For high net worth individuals, all right, estate and gift tax exemptions were permanently raised to $15 million and $30 million, which will be indexed to inflation. So again, that'll go up over time. That's just a big deal for estate tax. You won't get hit with that estate tax if you're married filing joint, if you pass on more than 30 or less than 30 million. So, and again, that'll go up over time with inflation. There is a 0.5% floor on charitable deductions for itemizers, people that itemize their taxes starting in 2026. And that's really just it for high net worth individuals. For business owners, this is going to be really quick. I don't know if this is going to apply to a lot of people, but for business owners, Section 199A, the qualified business income benefits, is a 20% deduction, which was made permanent, right? So that was the case before this point, and they're just not going to sunset that anymore. And now they're going to keep rolling that forward. So just make sure if you own a small business that you are reevaluating the structure of your business to make sure that you're taking advantage as much as possible of that new deduction, right? All right. So now for people that are family planning or education planning, and this is a new thing. So we're going to spend a little bit more time. This probably doesn't have a lot of implications for a ton of people, but something that I found interesting that this one big beautiful bill act started was something called Trump accounts, or really they're Treasury accounts, but they're getting deemed or nicknamed Trump accounts. But essentially, any child born between January 1 of this year, 2025, through 2028 will automatically have a Treasury account open for them, and then $1,000 will be seeded from the government into that account. So, and then that money will be invested in a U.S. index fund with a cap of 0.1% of fees, right? So basically a low cost index fund essentially is what's going to be used, is going to be invested in for all children born between January 1 of 2025 this year and December 31 of 2028, which in theory is a great idea, gets people maybe more involved, more interested in investing, seeing the impact that it can have on their lives, understanding and visually observing the effects of compound interest. So yeah, I think that it's a good idea in theory, right, to get people more focused, hopefully, on retirement. But basically, this account is going to operate like a traditional IRA. It's going to be held at a financial institution and invested, like I said, in a low-fee U.S. stock index fund. There's a one-time government seeding of $1,000 when the child is born. Private contributions can be made past this, so up to $5,000 annually, which will be after tax for parents, family, or family. And that number will be indexed with inflation. So the amount you can give annually will go up over time. Employers can contribute up to $2,500 annually tax-free, which will be subject to non-deduction rules. Nonprofits and public entities may also contribute beyond the $5,000 cap. Withdrawals on this account, no withdrawals are permitted until the child turns 18. After age 18, the account operates like a traditional IRA with a few rules. Distributions are taxed as ordinary income if used for qualified expenses. And these are things like education, home purchases, or starting a small business. Early withdrawals that don't fall in those categories are not considered a qualified expense, may incur the 10% penalty, just like any other traditional IRA would. So there's kind of a crossover between a 529-ish and a traditional IRA somewhat. We're not here to say whether we think this bill or these accounts are necessarily a good thing or a bad thing in the aggregate. I do think this gets people more invested or more provoked to think about investing and saving for retirement. There are more advantages to using a 529 if you're specifically trying to save for a child's education, because those withdrawals are not taxed if they are spent on a qualified a qualified item. You might want to make sure you balance that out or think about that before if you're debating between a contribution to a 529 plan or one of these Trump accounts. Think about what the intention of that money is for before making that contribution. If it's for education purposes, again, you might want to go with a 529. If it's for just wanting to see that child have a successful retirement, maybe a Trump account is the best thing to give towards. So that's really the one thing to consider there or to think about there. Also, if you are thinking about giving towards a child or wanting a child to have a successful retirement, and you want to seed them with some money, potentially opening a custodial Roth IRA might be more beneficial for them. So things to think about, things to consult your advisor about if you have questions. All right, what else did the Big Beautiful Bill Act do for families and education planning? For 529s plans specifically, they extended to cover certifications, licenses, and other professional qualifications. So I believe you can use a 529 plan to pay for things like a CPA, a CFA, CFP, things of that nature, which is great. I think that's awesome. Continuing to push our population to get more educated. Also, it increases K through 12 tuition cap from $10,000 to $20,000 starting in 2026. And then also for ABLE accounts, it increased contribution limits, extended savers credits, and the new law also permanently allows designated beneficiaries who make qualified contributions to ABLE accounts to qualify for the savers credit and permanently allows tax-free rollovers from 529 qualified tuition programs into qualified ABLE programs. I know I just said a lot. If you have specific questions about that, please reach out to us. We have an individual on staff that will probably know more about this than I do, but that is what the Big Beautiful Bill has done for ABLE accounts. All right. And just so we all know, ABLE accounts are short for Achieve a Better Life Experience accounts. Basically, they are tax advantage savings accounts designed to help individuals with disabilities save and pay for disability-related expenses without losing eligibility for government benefits like SSI or supplementary security income. So, and or Medicare. So that's what ABLE accounts are. They're very specific for individuals that or families that have individuals that have a disability. Finally, I know we're going a lot here. We might have gone over the 10-minute time shot or the target, but almost done. The last thing, and this is something I think President Trump ran on, but they did do the no tax on tips, right? So now there's no tax on tips up to $25,000, which phases out at $150K or for individual filers and $300K for those who are married filing jointly. And that's their marginal adjusted gross income, modified adjusted gross income. And that no tax on tips ends in 2028. Also, there is no tax on overtime pay up to $12,500 for individual filers and $25,000 for those who are filing married joint. Same phase out and expiration date as tips. So it'll end in 2028. So I know that's a lot. I rattled off a lot there. If you have any questions of how some of these things might apply to you, I know there's a lot of tax implications here, so you might want to consult your CPA. But we're more than happy to talk to you about it and see if any of these things would be wise for you to invest in or use or take advantage of. So there's a lot that's going on here. I know I rattled off a lot. So if you have any questions, please feel free to reach out to us. You can reach us at podcast@assetbuilder.com, or you can give us a call. If there is anything else you all need, please don't hesitate to reach out. Thanks so much for listening. Hope you all have a great day. If you have any questions for Adam, Janet, or Joey concerning this topic or anything else, send us an email at podcast@assetbuilder.com or visit us at our home on the web, assetbuilder.com, where you can set up time to meet with an advisor.